This video is my instant reaction to this news. I just saw an email come out from one of our lender partners advising that the Fed decides to hold rates steady. I automatically knew the 10-year treasury would fall off of that news, which it did. You could see right here based on this chart. I'll zoom in a little bit. You see, this is where we were. You can see the day down here, the date down here at the bottom when I put the line right up here. This is our high point, high water mark right there, 5.02. You can look to the right over here. You'll see what percentage the 10-year treasury was at on that date. And you see down here, you'll see the date. Okay. So you see Monday, October 23rd, we were at 5 point, like right, just a little bit above 5% on a 10-year treasury. Typically, what tends to happen is when any asset class hits a whole number, that tends to be when you see it move in the other direction. So at that time, I was already anticipating that we were going to move back down and we were going to head back down towards the 50-day moving average. The 50-day moving average is this blue line. So when I zoom out, you're going to see if we go all the way back down here, you'll see this thing has not broken below. I'm sorry, we're on the weekly chart right now. So this is actually a 50-week moving average, which is even more powerful, a more powerful indicator than the 50-day moving average because bonds are long-term assets. So you'll see down here as it was dropping, right? As it was falling from here, this was in 2018 and the 10-year treasury started to fall. This was bringing mortgage interest rates down. You see it cracked underneath the 50-day moving average, then it went underneath the yellow line, the 200-day moving average, and it stayed under both from this date, Monday, May 19th, all the way down here. This is all during COVID. It was down here, and then it didn't break above it until right around here, December 2020. From the point where it broke above the 50-week moving average, look at what happened. It went up, came down, hit it, up, hit it, up, broke through the 200-day, came back down, hit it, up, got close to it, up, came around it, kind of just consolidated around it, went all the way up, and this is where we are now. It's coming back to it again. I tend to look at all markets from a very technical perspective because the technicals show me what the human behavior is and what the sentiment is in the market. So the human behavior around the bond market has to do with institutions. We're talking governments, we're talking banks, we're talking pension funds, wealth funds, any giant entity that wants to find the safest asset to park billions of dollars in and get a yield on that investment. So if you could imagine if someone is managing billions of dollars and they buy the 10-year treasury right here, you're holding that for 10 years, you're guaranteed to lock in 5% for that period of time. That's pretty solid. That's your risk-free rate of return right there. So we're talking about U.S. bonds. That's about the safest asset you can find out there right now in terms of any market. Well, historically, it's been. I mean, this has been a pretty crazy move up. In the bond market, and this actually, you can imagine whoever bought bonds down here at this low number was getting a yield of 0.57%. How do they feel when it's up here at 5%? They have to do certain calculations on their books. If they have to, then they're underwater significantly with those assets. So I won't go too deep into that though. Let's stay on track where we're really going with this. Now, Fed holds rates steady indicates three cuts coming in 2024. The 10-year treasury is reacting not to this part that they're holding the rate steady. They're more so reacting to this part, three cuts coming in 2024. Because if the Fed is indicating, right, as if CNBC got this news correct, I have to go back and actually listen to the interview myself. But let's just say they did. If they are indicating, I think CNN also reported on this. Let's see, Fed rate decision. Let's see what CNN is saying. Dow surges, crossing 37,000 for the first time as the Fed signals three rate cuts in 2024. So they're interpreting the information the same way. So we have some consistency here now across two big networks. I still choose to listen to the Fed meeting myself just to make sure that I'm understanding it for myself. Okay. Now, what this means to me now is the market is front running what's going to happen in 2024. How much is going to front run it? We'll see. The key that I'm going to be watching from here on out is will it crack below the 50-day moving average, the 50-week moving average? I'm sorry. Not just will it crack below it, will it close below it on 2 consecutive weeks, because you see what happened over here. It went below it, then it went above it, then it went back right here, and it just went back above it. All right, top of the green candle means it's above it. Bottom of the red candle means it's below it. All right, so if we zoom in very, very closely, let's get all the way up in here. You see bottom of the red candle below the blue line, top of the green candle above the blue line. Bottom of the red candle below the blue line, top of the green candle above it, even higher. And we came back down. Bottom of the red candle below it, bottom of the red candle below it. This was kind of a fake out, because this was kind of indicating that, it could potentially drop lower, but there had to have been some news or something that caused this move back up. Because if you look at this, was a humongous move from this point. It just took off. But what you also saw here is technical a typical technical type of move. When you're coming down and the market is moving down and it starts to consolidate sideways. Um, Coming off of this consolidation, it's just indecision. It's waiting for something to happen. We need some news, we need something, and then the decision is made. Boom, we're going up, and then look at what happened from there. Went straight up like a rocket. Now something happened up here, and then it's coming straight back down. So, you can always check the news around these days to see what happened here and what's causing this to come down. But the key to watch now to see, okay, how much lower are we going to go on mortgage interest rates? Is going to follow the 10-year treasury. If we break below this 20-week moving average and we close multiple weeks below here and there's no news that's going to push it back up, then we could see it come down to somewhere down in this range, 3.3, 3.4, somewhere around here, to hit this area of consolidation down here. That's typically what these assets do. Right now, this is the point where I would expect, because this blue line is corresponding with the top of this move right here. If you look at it closely, you see it when you're looking at the dotted line. So that tells me that there is a good chance, if there is some type of news that could send this moving in the other direction, this would be the point where it's going to bounce. If it doesn't bounce here and start to move back up, then yeah, we're definitely looking at coming down, possibly closing underneath it for multiple weeks, and then continuing to trend down until we get down here, which would be a significant improvement in mortgage interest rates. So what does that mean? Does that mean you want to wait and not buy right now? It depends. It depends on the market that you're in. It depends on what type of deals you see out there. It depends on the sentiment on the seller side. Are sellers negotiating? Are they open to, giving seller concessions that you could use to buy the rate down? Whether you're doing a permanent buy down or you're doing a temporary buy down. It depends on your situation. I mean, are you looking to now where you have to renew a lease and you're paying a really high rent and you feel like it's just better for you to get into a mortgage? These are all factors to consider, but I don't think interest rate is the only factor to consider. Are you getting down payment assistance, a grant? Right now, there's a $5,000 Fannie Mae grant out there. I mean, that definitely makes up some ground, because if you break it down, let's say the difference between the interest rate you can get today versus the one that you would get a couple of months from now saves you $100 per month. Well, if you have access to $5,000 in grant money now and you're not sure if you can get it then, $100 a month, that's $1,200 a year. That's a little bit more than 4 years of savings from that $100 a month standpoint. So do you take the grant now and then maybe say, okay, I'll look to refinance in a couple of years. Maybe we get back down here somewhere with the 10-year treasury in the low threes, maybe even down here. Who knows? Depends on what the economy looks like, and then I could refinance this rate I'm getting that's in the fives right now back down in the threes and save maybe another $300, $400, $500 a month. Who knows? It's just it's really difficult to make a decision like that because no one has a crystal ball when it comes to this market. I tend to just look at the market from the standpoint of sentiment, and I'm a contrarian. So when it was up here and everyone was panicking, I was expecting it to come back down. So, we were being very patient at this point. We would talk to our clients and say, hey, what do you want to do? This is the situation. We can't predict where it's going to go, but this is what we're feeling is going to happen. Do you want to lock or do you want to wait? Um, we had to make moves with a couple of files because there was such a drastic difference when it moved back down. The great thing also is that some lenders, well, most of the lenders we work with will renegotiate the rate. So if it moves by, it's called 100 basis points, which I won't go in there, but that's a pretty significant move. But if we locked it here and then the market moved by 100 basis points, we could renegotiate and get a lower rate. Um, so there's different things that could happen. The market is not as just static the way that the news tends to report it, and it's not the way you see it out there as far as what interest rates are. There's a lot of different variables when it comes to interest rates. There's the credit score, there's the loan program. Is it an investment property? Is it a primary residence? How much money are you putting down? Is it FHA? Is it VA? Is it conventional? There's so many different details that dictate the interest rate. It's not just about what's going on, in the general market, right? One last thing I want to just touch on before I wrap this up. Just something I think that's also great information to always consider when you're buying a home. When we look at interest rates, we tend to just look at that number. Am I getting a 3%, 4%, 5%, 6% rate? And what I noticed that is rarely ever spoken about is how much interest am I actually paying over the life of the loan? So here we are on bankrate.com looking at an amortization schedule. And I'm going to use a $400,000 loan amount amortized over 30 years at a six and a quarter on the rate. So let's take a look at this and say, okay, if I actually stayed with this rate for 30 years, how much interest will I pay? $486,633. All right, let's say I don't refinance. Optional, make extra payments. Let's see. What if I, every year when I get, let's say I normally get a tax refund or I save up some money, I make an extra payment of 2463 straight towards principal, whatever my monthly payment is. So I'm going to go 2463 straight towards principal, additional yearly payment. That's monthly. Sorry. Let's go. I'm going to go 2463. Okay. I'm not gonna let's put zero in there. Every January. No, let's say every March after you get your tax return. Let's see what happened now. Look at what happened. Your total interest drops to 377,067. From what? Let's do the math. 377,067 from 486,633. 377,067. That's a savings of $109,566. And look at the payoff date. Let's do that again. So you're going to save $109,566 in interest over the life of the loan. And look at how much it's going to cut down the payoff date. And it's 2463, just one time a year, straight to principal in March 2048. So you went from, let's see, what year was that? Let's put the zero back in here. 2053 to 2048. 2053 minus 2048. 5 years. So you pay it off in 25 years, right? And you save over 100 grand in interest. Let's say you say, you know what? I'm going to do two additional payments of 2463 a year. Let's see what happens. 2463 every March. And let's say again in December. 2463 in December. All right, let's see what we have now. One additional payment. One time additional payment. Okay, I'm not sure why this didn't move. Let's get rid of this then. Let's zero this back on. Let's just double this up. Let's just say we do double. 2463 times 2 to 4926. Watch the number. 377,067. So we're gonna go 4926. Okay. Knocked off another 4 years. Knocked off another 60 grand. All right. So that's the difference. It just depends on what you choose to do. So you can make extra payments or you can not make extra payments. Let's say this is what you did. Let's round this up to 5 grand. So I'm gonna do 5 grand every March. All right. So now I'm gonna pay my loan off instead of let's see, 2044 instead of 2053, 2040. I'm gonna pay it off 9 years earlier. If you want to do that 9 years earlier, and I'm gonna save so 308,789. 308,789. So 486,633 minus 308,789. I'm gonna save $177,000 in interest, and I'm gonna pay it off 9 years earlier by paying 5 grand towards principal every year. Right. So let's see what your true interest rate would be then if you looked at that. So 308,789. Right. Let's see what rate we would have to drop this to get 308,789 if there were no extra payments. All right. See, let's try 5%. Still too high. Let's try 4.5%. Still too high. 307. Let's try 4%. Too low. 4.25. Very close. So a 4.25% rate over 30 years, you pay interest of 308,393, right? 6.25% rate, and you make an extra $5,000 every March straight towards principal, and you get almost the same exact number. You see what I'm saying? So just try to take that into consideration. It's not as static as it appears to be. You know, if you can afford the monthly payment and you love the home, it solves the problem you're looking to solve for your family. You move away from renting and you get into a property not to where you're building equity. And real estate over time tends to move, and set higher highs and higher lows. We could even pull it up. Let's just see real estate chart over 100 years. Let's see what that looks like. Okay, 100-year housing price index. Let's take a look at that. See what this looks like. This is in the 1900s here. Then here we go, 1960s, 70s, 2000. We came up, boom. We hit a crash, came all the way back down, boom, and then look at where we at now. So if we do drop back down, just looking at this chart, what this is telling me is that the market is moving in inverse of the value of the currency. Why do I say that? Well, let's look at what the definition of inflation is. Let's take a look at that. Let's say inflation definition. The action of inflating something or the condition of being inflated, or for economics purposes, a general increase in prices, and here's the key, and fall in the purchasing value of money. So inflation is also the fall in the purchasing value of the money, which means if you have $100, I'll pull up a chart. I'll show you, let's see, chart for value of US dollar, all right, since, let's say 1913. Let's see how that looks. 1913, 2023. Let's see. If in 1913 I purchased an item for $1, then in 2023 that same item will cost $31.02. The rate of inflation is 3,000%. So as you can see, the value of the currency is falling every single year because the definition of inflation tells you that it's going to do that. I'm not making this up. I just want to show the evidence. I just Googled it. You can Google it too. This is economics, inflation definition, increase in prices and fall in the purchasing power, purchasing value of the money. Why does this matter? It's moving in inverse to inflation. So as the purchasing power of the currency is falling, the value of the asset is rising. And that's what's happening here. So even though you do get these dips, you can expect that over time, as we continue to have inflation, that's how our economy is designed. The Federal Reserve tells you what the inflation target is that they have. So that means it's programmed into the financial system. So you can expect over time housing values to increase. That's why I always recommend buy the home. If it solves the problem for you, you're moving away from renting. At least now you're buying something that's going to be somewhat of a hedge against inflation. You can still live in it, and it's going to increase in value over time while the dollar loses its purchasing power. So that's how I look at everything. And that's how I put it all in perspective. And I look at the amortization schedule when I'm looking at making a decision, because I'm not going to let today's interest rate stop me from buying a home, because I know I can manipulate how much interest I pay anyways. And I could refinance this loan when rates fall. Yes, there is a cost to refinance, but what's the net tangible benefit of me refinancing? What do I mean by that? What's my net tangible benefit, right? So let's wipe this out. And I'm going to wrap this video up after this because it's almost 20 minutes long. So right now, 6.25% rate, 24.63 a month. Okay. If I drop it to 4%, what's my payment? 19.10. So I'm going from 24.63 to 19.10. Okay. 24.63 minus 19.10. $553 a month times 12 months, $6,636 a year. So if it's going to cost me 10 grand to do the refinance, I'm doing it because in 2 years I would have saved 12 grand. And then now I have the lower payment for the rest of the loan. So that's an easy decision. There's a net tangible benefit for me, right? So that's why I would do the refinance. So that's why I'm not going to let the 6.25 stop me today. I'm going to buy my property. And then if the payment is fine, I could manage it. Okay, great. Then I'll make my plans to I'll make sure, I'm saving up some money, drop that extra 5 grand on it every March if I want to, or I might put it into something else. So I'm reducing how much interest the lender collects. And then I turn around and I refinance and I get a 4% rate, right? 4% rate, and watch this number. Watch that interest, that total interest number now, how much that's gonna drop. So now it's at 287 because I'm at a 4% rate, and I re-amortize the loan and start it over on 30 years. Why am I doing that? Because I know that the currency is losing value. So why am I in a rush to pay the loan off faster? So I might not even pay the extra money to cut down the interest. It depends on if I have something else to do with the money that I could invest and use that to make money. If I don't, then okay, I made the extra payment and knock some interest off and save some money long term there. But what if I say, you know what, I'm the type of person where no matter what, I want to try to pay off the loan faster and pay as little interest as possible? Okay, now I have the 4%, and I'm still going to drop the 5 grand. So I'm going to go from 287 to 193. I just saved almost another $100,000 on the loan. So you see, these are the type of things that you can learn and you can show your clients. And then, or if you're watching this video and you are somebody looking to buy a home, you can understand how these things work. Just basic principles, basic definitions for economics, just kind of understanding what's going on when the 10-year treasury is moving up and down and how it's impacting the interest rates in the market, and then just looking at your personal situation and how you're going about making your decision to see if this is the right time for you or not. There's nothing wrong with renting. If you feel like this isn't the right time for you, rent for a little bit more and see what happens. But if you feel like you're sick and tired of renting and you feel like you're just throwing money away, buy a house. It's up to you. We're just here to help you to get whatever you want to get done. You might feel like I'm just going to keep renting and buying investment property. So my first property is cash flowing for me. It just comes down to whatever you feel is the best decision for you. We exist to help you to get whatever it is you're looking to get done, whatever it is you're looking to get done, and I'll provide you with information like this. So these are the type of analytics that we're looking at when we're consulting with our clients and we're watching the market and we're looking at all the different moving parts and people are trying to make decisions. Do I buy down the rate or do I just pay the extra money per year? To lower the amount of interest the lender is collecting. Every it's not a one size fits all thing. Everyone has different goals, different objectives. You may have one person that wants to pay off the loan as fast as possible, another person that wants to stay in debt and keep stretching the loan term out to play the game against, the devaluation of the currency over an extended period of time. So I hope this information helps. But yeah, this is great news for the mortgage industry, great news for the housing industry. And I'm also expecting that inventory will increase when rates fall. So when you hear people saying when rates fall, the price is just going to go up because now we're going to have all the buyers in the market, but you're going to have sellers in the market too, because there's a lot of sellers that's sitting on a lot of equity that want to sell and move to another property. So we may see an increase in inventory, and there's increase in inventory in a lot of markets right now. So that's it for this video. I hope you find this information useful. If you do, hit the subscribe button, hit the notification bell. I'm going to keep the information coming, whether it's the podcast. Make sure you watch the podcast, Money Talk, and make sure you also just check in every week to see what I'm doing, to see what I'm posting. I'm doing my best to share as much valuable information as possible across the spectrum when it comes to money, finance, real estate, mortgages, just what my expertise is in and business in general. Later.